So today I'm doing the most popular video series that I do on the channel, which is the stocks I'm buying July 2024. I can't believe we are in July already, 2024. I actually wrote down June. I had to rub it out and go, nope, it's July now. So July 2024 stocks I'm buying. So this is a series that I've done on the YouTube channel for many years, like 6, 7, 8 years now. Done it on YouTube for a very long time. It's a series where I post every stock that I bought and sold between the 1st of June to the 1st of July. The reason why I do it is so you guys can track along and see what stocks I'm buying. There's full transparency, so every move that I made on the market will be on this video. Anything that I sold will be on this video. I don't do what other YouTubers do and hide things, or if something didn't work out, I'll quietly hope you don't notice and I'll never mention it again. If I sold something, it'll be on here. Even if it hasn't worked out, it'll be on here, and everything that I bought is on here as well, so you guys can follow along. And for many of you guys that have followed on for many years, I guess you kind of know that. The only thing I will say is, a few people always ask about this, I will do my UK stocks in a few days time, so this is all the US stocks, and then I'll do the UK one probably in about another week for all my UK holdings that I bought and sold, so just so you're aware of that. But anyway, I'm mumbling on, so let's get started on today's video. Now, as always, if you do want to see some more exclusive content from me, join through the link in the description. You can join the Patreon. I post 2 exclusive videos a week on there. As well as that, you get to know what I'm buying and selling in real time on there. And there's also a Discord on there that you can join, and you get to talk to me, other investors out there. And it's a really good place just to share information. And all of that is £5 a month, a price of a pint. And it's the highest Patreon to subscribers out there on the whole stock market scene. Hopefully shows the bit of effort that I do try to put into that Patreon, and also it supports the channel. I am considering, it's £5 a month, I'm not gonna lie, I am considering potentially in the next month or at the end of the year putting that price up to £6.50. So I mean, it's not a mega difference, but if you want to save a little bit, it's something that I am thinking about in the background. So I'll just make you aware of that one now, so it gives you plenty of warning. As well as that, if you do join Trading212, that's personally the broker that I use to buy and sell shares. Join through the link in the description and you can get a free share worth up to £100. So let's get on to the stocks that I'm buying at the moment. And DraftKings, I did buy DraftKings. Granted, it was a very, very small amount, a lot smaller than what I used to buy, because I'm sure most of you guys know I am a big DraftKings bull. I have owned the stock for maybe around about 3 years now, and I've been posting it on the YouTube for many, many years. As you can see here, I'll just scan down. I mean, you got this video here from 2 years ago. GNOG, I remember owning GNOG, and that was a nice return. Forgot about that one. Yeah, I remember when Everything Money were making videos saying to sell DraftKings now, and I actually posted a response to it, and obviously, since that time frame, the stock has done absolutely amazing. However, in the last kind of couple of weeks, the stock's had a bit of a pullback. If you zoom out a little bit now, from where we hit the $47 around March time, we're having a bit of a pullback, 24% down. And I thought, you know what? I've not bought for a long time. I don't think I bought for maybe 2 years. I'm going to buy some. And it was a bit of nostalgia being able to talk about DraftKings again, and why I'm buying DraftKings. So, as most of you guys will probably know, it's not your first time hearing me talk about DraftKings. It feels weird doing this for the first time after like 2 years, but DraftKings, so they originally started as a daily fantasy sports, which you can get in the UK, but they have now also launched into sports betting and iGaming. So sports betting is, you know, let's say you watch the NFL game and you think the New York Giants will beat the New York Jets, and you might put some money on that. So there's the sports betting side of it. The iGaming side of it is where you potentially go on instead of being on the slot machines in person, you go online, you do online slot machines or poker, what have you. And this is only just been allowed in the US. So this only got allowed in 2018 thanks to the US Supreme Court ruling. Since then, there's been a big explosion in the space, and DraftKings has been one of the major players, and they have taken big market share. People said this was going to be a very competitive market, but yeah, it's pretty much a duopoly. It's a duopoly between them and another company called FanDuel, and you can see here the market share gains that DraftKings have taken because they've got the best platform out there. And whether you want to look at on sports handle, GGR, iGaming, or combined, let's go with combined. They have about a 33% market, which is pretty impressive, as you can see here. You look at all the states that have online sports betting and iGaming, so it gives you a good indication here. I think it's around 50% have the sports betting at the moment. Only 5 states have the iGaming, which is a massive growth driver that people are sleeping on. Is that people talk about sports betting all the time, and you know, imagine when Texas comes online or Cali comes online. imagine all these states as well when iGaming comes online. It's going to be an absolute booming time for them. DraftKings obviously give good guidance for states that are already allowed, but if they have all these states come online, it's going to be amazing. They've also said they're going to potentially look at entering into Brazil, actually. If you look at the payback period, so what they do is they put a lot of money into the state launches, and then they spend a lot on sales marketing, adverts, and then they pull that back, and hopefully the customers stay with them for a long time. You know, normally when you sign up with the betting partner, you stay with them and you don't switch. There's always a few people that will switch, but 90% stay with the same player or app or betting platform for many years. And what used to happen, it used to take them 3 years to get the payback, and then it went all the way down now to 2.3 years. So not too bad at all, and that's the perks of being able to do a lot of like national advertising now, what they do. But the other thing is that when you look at the net revenue, is that when these states come online, they don't just come online and stay stagnant, they continue to grow for many years. An example here is New Jersey. So if you look at New Jersey here, if you look at the revenue growth from when the state first launched to where it is right now, through like fantasy sports and everything, and then we finally had the launch into like the online sports betting, and you just see it grows year after year after year. And if you look at the online sports betting as well, and the iGaming, I mean look, by the way, look at how much the iGaming is, and it's only allowed in 5 states. I think a lot of people are sleeping on the iGame side of it, but online sports betting as well has shown very growth. And even though the state is what you'd call the mature state, it's still growing 25%, which is very good. So you imagine all these states that are yet to come online, and if they copy like the likes of New Jersey, imagine the growth that's going to be happening there. It's very good. They don't even need new states to come online to be successful, but if they do, and iGaming comes online, imagine where that's going to see them be. It's exciting. Now, obviously, it's a little bit of a rich valuation. Obviously, when I first started buying DraftKings, it wasn't a rich valuation. It was, a $10 stock, and now everyone was saying it was a terrible stock. They'll never be profitable. They'll never take good market share. And now you pick it up for 81 times earnings, and all those things that the people used to say, they don't happen anymore. Because if you look at the business, the revenue has continued to grow at very good rates, as you can see here. The profit is on its way. We are probably going to see the first profitable quarters starting to kick in, and then a full year of profit. 423 million is no small amount of profit if they do get there, and very quickly and very scary how quick that revenue is growing, and while that profit is now coming up, which is very good. So for the valuation, it's at 81 times earnings, and considering the growth drivers they have, that if states come online, iGaming, and none of that is priced in at the moment, and also you've got the jackpot acquisition that's going on in the background. They always sandbag the numbers. It looks very exciting for DraftKings. The only reason why the stock did drop is because a state was thinking about hiking up their tax rates, which I think will be an issue maybe a bit further down the line, that a few more of the states do get a little bit greedy. But at the end of the day, when you're so early into a major growth driver, and we've seen them actually have the high tax rates in New York and be successful, I think maybe there's a bit of an issue with that point of view. But if anything, it says to all these states that are currently missing out completely on any iGaming or online sports betting taxes, we're going to allow it because we get to make more tax from them, and I think it will happen. It's very exciting. It's a very exciting stock. It's why it's my number one position out there. Next one, Fiverr. So I did buy into Fiverr. The stock seemed to be rallying up a little bit. Had a bit of a rally, fell down a little bit, and then it had rallied up. And in the last kind of few days, given a little bit back once again. It's been a little bit choppy around from Fiverr. 886 million market cap, 107 times earnings, but that's not exactly correct, and I'll show you that in a little bit of a second. So Fiverr, as you can see here, I do use Fiverr myself. I like Fiverr. Basically, it's a platform where you go to service providers, whether that be graphics design, programming, tech, digital marketing, AI potentially, AI services, as you can see here, is a new one, and you pay a freelancer and they will do a service for you. A lot of companies now are moving to the freelance model because it suits the employees. They get to select who they work for, how much they get paid for it, and companies themselves, they potentially don't have to hire someone 5 days a week. They just get them in when they need them. If you look at Google, for example, I think Google has someone like 45% of their workforce. I think it says somewhere down here, but I'm quickly trying to talk and scan and find it, and I can't find it. But I think it's something like 45% of their workforce is actually now freelance, which is crazy when you think about it. And the company's actually doing really well. You look at the company, good EPS beat on the last quarter. They grew 6% year over year. The spend per buyer was up a lot. A lot of people don't do the the big digging into a lot of companies. Unfortunately for me, I do. Sometimes it can take a while to do all the big digging, but I like to look into what's exactly going on. And if you actually look at the spend per buyer, it was up 8%. A lot of what Fiverr are doing now is they're focusing the big products or projects. They're focusing on the AI, which is a longer term product. To build an AI service, it can take weeks to do, and that's why the big spending is going up. A lot of people talked about the by the way, the take rate did go up quite a bit, which is quite impressive considering what they're charging now. But a lot of people looked at the active buyers and saw they went down. The reason why they went down is because Fiverr is not prioritizing people like me anymore. They used to offer big incentives for people to get these smaller projects. What they're actually focusing now is on these big projects like AI, and that's why the spend is going up. So that levels out where they're not getting those kind of cheaper customers anymore. They're focusing on the customers, and if you're spending more, you're taking more. So I think it's a good thing that they're doing that at the moment. And the thing with Fiverr as well is they're currently buying about 100 million of its stock back. Considering the company is around about a 866 million market cap, yeah, they're buying over 10% of the market, the company back, which is also very nice as a shareholder. Also leads to a forward P of 10 times earnings, which because they're ramping up profitability so much, which 10 times earnings for a company growing at 6% with a lot of growth drivers for them. Yeah, I like it, so I am picking up some Fiverr. Next stock, Celsius. So I picked some more Celsius up. This has been a stock that's done really well for me. It's a stock that I used to buy in 2022. Sold some shares out at like 40, 30, 40%, 50%, 80%, 90%. I think I've even got 100% return on Celsius at some point. Done really well for us. Even from that time frame, if I did hold all my shares, I'd be up 22%. However, I did sell the stock, and then eventually I have started buying back into the company, and I'm about break even on Celsius. I was actually up over 50% on Celsius, but however, it's had this big drop off in the last kind of couple of weeks. It's been quite volatile, as you can see here. But Celsius, I've covered on the YouTube many times before. You can see 2 years ago I was talking about it before I actually sold it and made good money on it. But I think it's another good opportunity right now. They do energy drinks. I like these energy drinks. I prefer them over Red Bull and Monster. I think Red Bull is very sickly and not very nice tasting, and I feel like you're just too hyped up after them. Monster, I think as well, is a little bit, you get a little bit too hyped up after them, a bit too much. Celsius, I think, is just the kind of right amount of sugar, in my opinion, where you're not kind of feeling all like your eyes are going all over the place, and after you have the come down, it's actually horrible for it. Celsius I actually really like, and I do like buying the Celsius. They used to be in the US, but they have just moved to the UK, so if you do go into your local Tesco, you are probably going to see a Celsius now, or if you don't, you'll probably see them soon. So there's the big international expansion going on now outside of the US into the UK. However, the stock is down at the moment because at the moment they are saying the data is coming out a bit weak from Nielsen's. What's happening at the moment is PepsiCo are the supplier. PepsiCo is ordering less at the moment, which is a suggestion that they are slowing down. However, a few people are saying the reason why is just they took over as a supplier about a year ago, and people saying like, oh, they took over as a supplier, they ordered loads in, and now they're just trying to rebalance the stock a little bit. They're also saying that sales growth is down to 39% a year now. 39% a year is, if that's slowing down growth, I will take that all day. So I think it's just a natural, like, the scale has got so big now for Celsius, they can't grow at the crazy rates they used to do every year, which was like 50-60%. I think they're going to come more to a more realistic level now, which if it's 39% a year, I'll be happy with that all day. Looking at analyst forecasts, they're expecting 27% year-over-year growth, which I'll take all day once again as well. I can't remember exactly what the company's trading at on a forward basis. Yeah, it's currently trading at 42 times earnings on the forward basis. 42 times earnings for a company growing at nearly, high 20%, nearly 30% revenue growth. EPS ramping up massively. Very good balance sheet, very profitable. You just started your international expansion into the UK. Yeah, I will buy Celsius at these levels, and I will take their slow growth of 27% all day. So a lot of negativity out there with Celsius at the moment, and people panicking over the data, which I think is like all priced in now. So I'll buy some Celsius. Next one, SoFi. I did a video on SoFi a few days ago, so I'll try to keep this one nice and brief, but I was surprised to see the negativity out there. There's a lot of people that don't like SoFi. I thought a lot of it was the big banks. I thought they were getting a bit upset that SoFi was disrupting them. Also, it looks like there's a lot of people out there, like there's a lot of comments on there saying like they're not a fan of SoFi, which really surprised me. I don't know if it's just because the share price has been a little this year. Everything's been doing so well. Everyone's looked at the video and gone, oh, Nvidia, anything that's down is a bit crap. You look at SoFi, it's down 33% year to date, but I think the stock price is nowhere near reflecting the financials on this business. SoFi, fintech platform. So you go to this, it's now got its bank license. They offer a lot of products like personal loans, banking. Used to start off as a student loan business, but expanded even more now. Focuses on a lot of the younger generation, obviously wanting to get the best deals, all in one place, all online. And as these younger generations get older, they're probably going to use more of the products here, like the mortgage loans, for example. And also when we get a better economy as well, imagine how some of these things are going to do in a better economy, what SoFi is going to do in a good economy as well. But even considering the economy that we're in, member growth has been very impressive, as you can see here. The cross-selling more products that they currently offer as well. And what that's led to now is a company that is growing at very good rates at the moment, and also is going to throw off good amounts of profitability, as you can see here. Pretty decent balance sheet. You've got a CEO that I think is a very good CEO. If you ever go listen to Antinoto, I think he's very good. And he is buying shares on a very regular basis. As you can see here, nearly every month we're kind of seeing him buy some more shares, which is very bullish to see, and I think even in fact a lot of his pay as well comes from shares. So a big fan of Antinoto as well. So yeah, I like SoFi, which leads me on to another fintech platform that I'm buying at the moment, which is Block. So I have started buying Block again. I thought the numbers they've recently done are very good. EPS with a good beat, revenue growth of 20%, as you can see here, which is very good, the best growth they've done for a while. They have Cash App. Cash App is a platform that a lot of people use to send each other money, one of the most popular forms of sending money out there in the US. They're also looking to try and monetize Cash App as much as possible now, which is really good. But as well as having just the Cash App, they've got obviously the payment solutions. They have also business solutions, which is a big growth driver for them, as you can see here. And obviously with a lot of it being subscription service, the profitability they throw off is absolutely insane. The cost of revenue is nearly 269 million, and yet they're making nearly 1.6 billion on it, which is absolutely insane. Also, the valuation is the cheapest that I think I've ever seen it at 19 times forward earnings. And if you do look at the numbers that Square or Block is doing at the moment, 15% growth expected this year, good growth in the profitability. I think that this is a very fair valuation for a company growing at these levels. So I have been buying into a little bit of Block, which leads me on to my last stock on my buying list, which is Evolution AB. A relatively new position this year, actually, but I do like Evolution AB. It's 90 times earnings. You do get a pretty nice 2.8% dividend yield on this one. It is listed on the Swedish stock market, and it also has a dual listing on the US market as well. That's why I do put it on the US stocks I'm buying video. Evolution, basically an online game provider to the likes of DraftKings. So these two, tie quite nicely together. Evolution's getting all the kind of benefits that DraftKings get, where there's all this boom in iGaming going on in the US, and Evolution is like a provider. They actually are a client of DraftKings, as you can see here, and what they do is they go to DraftKings going, hey, you don't want to sort out all these live casinos and everything like that, so we do it for you, and then we just take a cut from it. So they go to all the likes of FanDuel, DraftKings, and do all the online poker games for them, and then they just blackjack, and then they just take a cut from them, which they've done for many years. They've got a lot of games. They're also in Europe. Asia's a pretty big growth driver for them, Latin America as well, and they've had much success over the years from doing this. It has the valuation is very good. The growth has been very good because it's still growing massive in many areas. Good amounts of profitability, as you can imagine as well. Cracking balance sheet. There's no debt, I believe, on the balance sheet. Yeah, they sit on a pretty healthy amount of cash. Sometimes they use those for acquisitions, which is very good. And you even had the CEO actually pick some shares up in November time as well. So yeah, Evolution, I'll pretty much do a copy and paste for DraftKings because the growth drivers are exactly the same for them. Just it's a bit more of a picks and shovel kind of play, whereas DraftKings is actually at the front, and it's their name that people are using anyway. And that leads me on to the selling. So there was two stocks that I did sell over the 1st of June to the 1st of July. Hims and Hers, I did not sell. Don't panic. don't panic. It was not my whole position in Hims and Hers. I think it was around about 2%, which isn't much really. Well, I say it's not much really, but when it's your second largest position and it's a big position, 2% was a fair, nice amount of profit I did take from it. So I did just trim the position by 2% in Hims and Hers. The reason why the stock just went absolutely crazy, as you can see here, I mean, by the 17th of June, we'd gone up nearly 100%. And I was just looking and thinking, this is getting a little bit too crazy here. And I just thought, you know what? I'm going to take some money off the table. Since then, the stock has fallen back a little bit. However, I still want the stock to do very well, and I'm still very much committed to the stock in the long term. Otherwise, I would have sold more than 2%. But I just thought it was a good time to release some capital. And I did actually use that capital to go buy a couple of stocks as well. So, yeah, I just wanted to just take a little off the table. 2%, nothing major, but it was a bit of a gain. I think we made something like 280% profit off it when I sold. So yeah, 280% profit is very nice. It's been a while since we've gone not just 100% return, but we start talking about 200, 300, 400% returns. It's been a while since we've said them sort of numbers. So it was nice to take a 280% return off Hims and Hers. And the last one was Walgreens. Obviously made a video about it on Sunday, was it? Saying that I did sell my Walgreens after the update they gave. I did take around about 50% loss. It might have been actually a little bit more, like maybe 51, 52% loss. I didn't really track it completely, to be honest with you, but it was around about 50% loss that I took on Walgreens. I guess you could potentially add, maybe the dividend yield on it to that maybe makes it a little bit less worse, but it was still a bit of a bigger loss. I just thought I'll cut it before it gets a lot worse. The plan that I had of it turning around, as I said on the video the other day, is it didn't happen. I thought they were going to, get into the Village MD business, combat, with CVS Health, a lot more curbside pickup. It's all fallen apart. The new game plan now is to cut all the unprofitable stores, which might work out for them, to be fair, but it's not what I originally invested in for, and I'm not sticking around to see if that plan does not work. It does work out or not, because that's a big issue. And you don't know whether financials are going to settle on the revenue profit point of view, and it was just a big change around in the business, that one. And I thought, you know what, I can use this 50% that I have left in the business to put it into a new stock, and hopefully that brings me 60, 70, 80, 100% returns in the next 3, 4, 5 years. And rather than hoping it works out for Walgreens, I could buy a stock that I really like, and I have a lot more confidence that will make up the losses, which I think actually was SoFi. I think I put the Walgreens money in SoFi, and hopefully SoFi does, if SoFi goes to $12, wherever the slide for SoFi is, if SoFi does go to $12 in the next 3-4 years, it will look like a genius decision. If it doesn't, then it won't look a genius decision. We'll see what happens anyway. So yeah, that's what I did with Walgreens position anyways. Most of you guys know because I did the video on it. Anyway, that was a bit of a long one. Hope you enjoyed the video. If you could, hit the like button. Let me know what you've been buying and selling in the month of July as well. And thanks for watching, guys. And I'll see you all maybe tomorrow, maybe on Thursday, maybe Friday, maybe next week. We'll see what happens. See you in a bit.